Towards the end of last year, Vanguard published a report detailing the economic outlook for 2025 and what that might mean for you. In it, they provided their expectations for the stock market and suggest that bonds will perform far better over the next decade than in recent years, and that holding a balanced portfolio that includes higher proportions of bonds would be the key. So in this video, I'm going to go through the highlights of that report, but before doing so, I thought it would be useful to quickly explain what a bond is. But if you already know and you want to get to the report, I've left chapters on the timeline and in the description below to help you jump to wherever you want to go in the video. So, a bond is essentially a loan made by an investor to a borrower, which is typically a corporation or a government. When you buy a bond, you're lending your money to the issuer in exchange for periodic interest payments and a return of the bond's face value when it matures. Here's a simplified breakdown. You have the issuer. This is the entity that borrows the money, for example, a government or a corporation. You have the principal. This is the amount of money that is lent, also known as the face value or the par value. You have the coupon rate. This is the interest rate the issuer pays you for borrowing your money. This is usually paid periodically, for example, annually or semi-annually. And you have the maturity date. This is the date when the issuer repays the principal amount of the bond to the investor in full. You do not become a shareholder of any business that you purchase a bond from, so won't benefit from any gains in the price of shares from that company. But also, you do not have to worry about the share price falling, and you know exactly what your return will be, i.e. the regular coupons and your full money back at the maturity date. Bonds are tradable and can change in value at any time up to the maturity date. However, the full value of the bond is paid back by the issuer of the bond to whoever owns it at the time of maturity. And the maturity date with bonds can be anything between 1 month and 25 plus years. Between the time of issue and the maturity date, various factors can cause a bond to fluctuate in value. The change in interest rates is the most significant. When interest rates rise, bond prices fall, and when interest rates fall, bond prices rise. This inverse relationship exists because new bonds are issued at the current interest rates, making existing bonds with lower rates less attractive. The creditworthiness of the bond issuer can impact bond prices. If the issuer's credit rating is downgraded, the bond price may decrease because the risk of default increases. Conversely, an upgrading credit rating can boost bond prices. Inflation erodes the purchasing power of future cash flows from a bond. If inflation expectations rise, bond prices tend to fall, as investors demand high yields to compensate for the loss in purchasing power. The supply of and demand for bonds in the market can also affect their prices, and general economic conditions and outlook can influence bond prices. For example, during economic downturns, investors often seek the safety of bonds, driving up prices, and vice versa. Investor sentiment and expectations about future economic conditions, interest rates, and other factors can lead to fluctuation in bonds prices. These factors individually, or in combination, contribute to the dynamic nature of bond prices in the market. So now that we have a basic understanding of what a bond is and how it works within financial markets, let's take a look at what Vanguard are predicting for 2025. Firstly, Vanguard predicts that US economic growth will slow. Although the US has been experiencing strong economic growth, falling inflation, and a relatively healthy jobs market, Vanguard estimates that some risks could offset these factors, including higher tariffs and tighter restrictions on immigration that is expected in the Trump administration. As a result of this and other factors, US growth is expected to slow from 3% to 2% in 2025, with any significant interest rate cuts being difficult without the risk of fueling inflation. Vanguard predicts that growth outside the US will be mixed. In Europe, although inflation is close to the ECB's 2% target, there has been little or no growth for the past 2 years, and this is expected to remain below long-term averages for 2025. In the UK, Vanguard predicted that the UK would see growth rises higher than the long-term averages due to measures implemented in the autumn 2024 budget. But inflation remains sticky, with service inflation still elevated, and growth figure rises of only 0.1% being published for November 2024, failing to offset the falls in September and October. Add to this the rising cost of the UK government borrowing through bonds, or gilts as they are better known, where investors are wanting a better yield for what they see as a higher default risk from the government as compensation for lending to them. And this rise in borrowing is being reflected globally, pushing the value of bonds upwards across the world. Vanguard believes that growth in China will pick up as a result of stimulation measures imposed by the government in 2024. Vanguard believes that the long-term outlook for shares is more cautious. US shares have provided strong returns in recent years, but in Vanguard's view, share valuations are elevated. They believe that without a shock to the US economy or to companies' earnings, US stocks can continue to defy concerns, but ultimately, high valuations will drag down long-term returns for investors, where annualized returns of a much smaller 2.9 to 4.9% is expected for the US shares over the next decade. Shares outside the US might be a more attractive proposition. Vanguard expects annualized returns of 5.7 to 7.7% for the UK, 7.4 to 9.4% for developed markets, excluding the US, and 5.3 to 7.3% for emerging market shares. Vanguard believes that interest rates will support bonds. With higher interest rates in recent years, bond yields have increased also. Even though central banks are cutting interest rates, Vanguard expects rates to settle higher than they did in the 2010s. This sets the stage for solid bond returns over the next decade or so, where annual returns of between 4.3 to 5.5% are expected. If interest rates fall, then existing bonds are likely to benefit from higher prices, with those existing ones paying a more attractive interest rate. Even if there is a moderate rise in interest rates, the higher income stream from existing bonds should help keep total returns positive. Vanguard believes that there is a very good case to include bonds in a long-term portfolio to offset fluctuations in other investments such as shares, and they believe that holding a balanced portfolio is the key. The strong outlook for bonds, together with a more cautious long-term outlook for US shares, means that holding a balanced portfolio is key. As an example, Vanguard expects balanced portfolios of 60% shares and 40% bonds to return 5 to 7% over the next decade. So now we know what Vanguard thinks. So let's take a look at a few other factors as to why you might want to include bonds in your portfolio. Bonds provide regular interest payments, offering a reliable and consistent source of income. Unlike stocks, bonds offer predictable returns, making them attractive for conservative investors. Government and investment-grade corporate bonds are generally safer than stocks, and bonds are considered lower-risk investments compared to equities, providing capital protection. Including bonds in an investment portfolio can help diversify risk and reduce overall volatility. Bonds can balance out the higher risk of stock, leading to a more stable investment portfolio. This is achieved as the price of bonds tends to react differently to market conditions than other investments such as stocks and shares. Things that cause the price of a share to fall might not affect the price of a bond as much. This can reduce price volatility in your portfolio. And on the subject of volatility, bonds tend to be less volatile than stocks, providing a more stable investment option, and in certain market conditions, bonds can offer a safe haven for investors. Predictions suggest that interest rates may not fall significantly, making current bond yields attractive. While inflation is expected to remain a concern, bonds can still offer a hedge against this. Many financial firms are forecasting higher returns for bonds compared to stocks over the next decade, and bonds are expected to provide steady, long-term returns, making them a viable investment option. As individuals approach retirement, shifting to bonds can provide more security and income stability, and lower risk tolerance may lead investors to prefer the relative safety of bonds over the unpredictability of equities. Bonds could be a prudent long-term choice for 2025 for those seeking stability and steady returns in their portfolios. You have seen from the portfolio updates that I publish on this channel that I favour 40% exposure to bond in my portfolio. I do this not out of tolerance for risk, but in search of stability due to age and wanting a calmer ride as I close in on retirement. This scenario might not match yours, and you need to consider your individual circumstances, financial goals, risk tolerance and market conditions when making investment decisions. Seek the advice of a suitably qualified professional if unsure of anything to do with investing, and please leave a comment below if you have any questions. Thanks very much for watching.